I gave ChatGPT $1,000, virtually, and told it to build me a crypto portfolio from scratch. Then I actually invested the money according to what it said. 3 months later, here are the results, the honest, unfiltered numbers. Before I show you the results, let me walk you through exactly what I told ChatGPT and what it recommended, because the process is as important as the outcome. To get a useful answer, I couldn't just ask what crypto should I buy. That's a recipe for a generic, useless response. Instead, I needed to give the AI a detailed persona to work with. I started with the basics: $1,000 to invest, a 3-year hold period, and a moderate risk tolerance. I also specified that I'm 28 and have a 6-month emergency fund, making it clear I wasn't gambling with rent money. Finally, I gave it the most important instruction: build a diversified portfolio with specific percentages and, crucially, explain the reasoning behind every single choice. I hit enter, and the wait began. The response was a surprisingly thoughtful 5-asset portfolio. It allocated 55% to Bitcoin for stability, calling it digital gold. 25% went to Ethereum as the primary growth engine, 10% to Solana, a high-speed competitor, 5% to Chainlink, a smart bet on the industry's essential plumbing, and a final 5% moonshot in FET, an AI-native token. Each choice was logical, well-justified, and perfectly aligned with the persona I had created. So, how did the AI arrive at this specific portfolio? It wasn't a random selection or a chase for the latest trending coin. The core principle was to build a diversified portfolio that balances established leaders with high-growth innovators, strategically covering different non-correlated sectors of the crypto economy. This approach aims to capture upside across the market while mitigating risk. Let's break down the rationale for each pick, starting with the titans, Bitcoin and Ethereum. The AI designated these two as the bedrock of the portfolio, allocating the largest share of capital to them, and for good reason: stability and an unparalleled track record. Think of them as the blue-chip stocks of the crypto world. Bitcoin is the original, the digital gold. Its primary investment thesis is its function as a store of value, a hedge against inflation and currency debasement in an increasingly uncertain macroeconomic environment. With a mathematically enforced fixed supply of 21 million coins and the largest, most secure, and most decentralized network, it has weathered every market storm for over a decade. Its brand recognition is unmatched, and it's the primary gateway for institutional capital entering the space, as evidenced by the approval of spot Bitcoin ETFs. While it's not designed for high-speed daily transactions, its proven resilience and established narrative make it the portfolio's non-negotiable anchor. Ethereum, on the other hand, is the world's leading smart contract platform. If Bitcoin is digital gold, Ethereum is the decentralized internet's foundational layer. It's a global, programmable computer that powers the vast majority of decentralized finance, or DeFi, as well as NFTs, blockchain gaming, and thousands of other applications. Its transition to a proof-of-stake consensus mechanism, known as the merge, significantly reduced its energy consumption and introduced a deflationary element to its supply, making ETH a productive, yield-bearing asset. Investors can stake their ETH to help secure the network and earn rewards, creating a native digital yield. While it faces challenges with high transaction fees during peak times, its massive developer community and the burgeoning ecosystem of Layer 2 scaling solutions built on top of it solidify its position as the dominant infrastructure for the decentralized web. Together, Bitcoin and Ethereum provide a robust foundation of proven value and market leadership. Next, the AI selected Solana as a high-potential Layer 1 blockchain. While Ethereum is the established leader, its network can get congested, leading to high fees that price out some users. Solana was chosen to capture the high-speed, low-cost narrative. It's a monolithic blockchain designed for massive scale, boasting theoretical speeds of tens of thousands of transactions per second for fractions of a penny. This raw performance has attracted a vibrant ecosystem of applications that require high throughput, from decentralized social media and gaming to high-frequency trading and fast-paced NFT mints. The AI's rationale points to its impressive and verifiable on-chain activity and transaction volume, suggesting genuine, sticky user adoption that survived a brutal bear market. Of course, this potential comes with trade-offs. Solana has faced criticism regarding its decentralization and has experienced network outages in the past, which are significant significant risks. However, the AI weighted its explosive growth potential and proven technical prowess as a worthy inclusion, representing the primary challenger to Ethereum's throne. Blockchains, by their nature, are closed, deterministic systems. They can't access external, real-world information on their own, which severely limits their utility. This is where Chainlink comes in. The AI identified it as critical infrastructure, the connective tissue between blockchains and the vast universe of off-chain data. Chainlink is a decentralized Oracle network that securely and reliably feeds external data, like asset prices, weather information, or sports results, into smart contracts. This capability is not just a feature, it's a necessity for almost all advanced DeFi applications. For example, a lending protocol needs Chainlink to know the current price of collateral, and a parametric insurance contract needs it to verify a weather event. By including Chainlink, the AI is investing in a fundamental picks and shovels play. Its success isn't tied to a single blockchain, but to the growth of the entire smart contract ecosystem, making it a crucial, cross-chain bet on the continued integration of blockchain technology with the real world. Finally, to add a forward-looking thematic bet, the AI chose Fetch.ai, or FET. This represents the portfolio's dedicated exposure to the powerful narrative of AI and blockchain convergence. Fetch.ai is building a platform for creating and deploying autonomous AI agents that can perform tasks, negotiate, and share data on behalf of individuals or organizations. Think of them as personal AI assistants that can operate in a decentralized digital economy, booking travel or trading assets for you without intermediaries. The thesis is that as AI becomes more integrated into our lives, we'll need a decentralized, permissionless network for these agents to operate and transact value securely. This is a high-risk, high-reward play. The field is nascent, and the token is inherently more volatile than the other assets in this portfolio. That's why the AI allocated a smaller position to it. It's a strategic bet on a powerful, long-term narrative. The future of a decentralized AI economy. It's important to remember that all these assets, even the established ones, are subject to high volatility and significant risk. The crypto market can experience sharp drawdowns, and past performance is no guarantee of future results. Alright, the moment of truth has arrived. It's been exactly 90 days since we handed over the reins to our AI, tasking it with building and managing a diversified crypto portfolio. We started with a simple, clean slate, a $1,000 initial investment. The goal wasn't to chase fleeting moonshots, but to test a hypothesis. Can a logic-driven, thesis-based AI construct a portfolio that not only grows, but also demonstrates resilience and outperforms the market's emotional whims? The past 3 months have been a classic crypto roller coaster, full of unexpected rallies, sudden dips, and shifting narratives. And to be clear, it wasn't a smooth, straight line up. At one point, the portfolio experienced a maximum drawdown of nearly 12% before recovering. So, how did our AI navigate this complex and volatile terrain? Let's pull back the curtain and dive into the results. After 90 days, our initial $1,000 investment has grown to a current value of $1,143. That translates to a net return of 14.3% in a single quarter. On the surface, that's a very strong number, but performance is meaningless without context. To truly understand if the AI made smart decisions, we need to benchmark it against the wider market. During that same 90-day period, the broader crypto market, as measured by a total market index excluding Bitcoin, averaged a return of around 8%. For even broader context, the S&P 500 returned about 3.5% in the same time frame. So the AI's portfolio didn't just make money, it significantly outperformed its direct benchmark. This outperformance is the key metric. It suggests that the AI's specific asset selection and weighting provided a genuine edge over simply buying a basket of the top 100 coins. The question is, why? Let's break it down. The outperformance was primarily driven by the AI's strategic allocation to Layer 2 scaling solutions and its small, targeted bet on the decentralized AI narrative. Specifically, our holding in Fetch.ai, or FET, was the star performer, surging as the AI crypto sector gained massive traction. This single position was the primary engine of our growth. Meanwhile, our core holdings in Bitcoin and Ethereum acted as the portfolio's stable foundation, providing steady, albeit less dramatic gains. Other assets like Solana and Chainlink performed roughly in line with the market, contributing positively, but not driving the outperformance like FET did. This combination of a stable core and a high-conviction satellite position is what delivered the alpha. Now, let's be perfectly clear. 3 months is a very short time frame in the world of investing. It is not nearly enough time to definitively prove that this strategy is a long-term winner. A different 90-day window could have yielded completely different results. We could have been caught in a black swan event or a sudden market crash, which would have tested the portfolio's defensive characteristics in a much harsher way. This period happened to be favorable for our specific theses, but that won't always be the case. But this initial result is more than just a number. It's an incredibly promising validation of the core framework. It demonstrates that a diversified, logic-based and thesis-driven allocation strategy has the potential to beat impulsive, emotion-based trading. By removing human biases like fear of missing out or panic selling, the AI stuck to its plan, rebalancing methodically and letting the underlying theses of its chosen assets play out without emotional interference. This early success isn't a finish line, it's a critical data point that encourages us to continue this experiment with confidence, observing how the AI adapts to new market conditions over a much longer horizon. The full ChatGPT prompt I used is in the description. Copy it exactly, fill in your own numbers, and try it. I want to hear what portfolio it builds you, share it in the comments, and subscribe because in 30 days I'm doing an updated results video.